Now, last week overall, Professor Robert Shiller of Yale, I'm sure you know who he is, probably know him personally, told us that valuations are so high, the market has become a little bit dangerous. Here's what he said. Listen.
It hasn't been this overvalued except a couple times in history, around 1929, around 2000. We're above the 2007 valuation. Right now is a good time to look at one's portfolio and ask if it's diversified enough. You know, there's Europe over there, there's Asia over there, and I think most Americans are not well diversified globally.
Okay, what are your thoughts, Aswath?
Well, the part of it that I agree with is we should all be more diversified. But the part that I don't get is, how is diversification going to protect you if there's a market crash? If the market crashes in the U.S., it's going to crash in we're all linked up at the hip. It's not the 1980s where the U.S. market can be down 40%, the European market is going to be up 10%. If we're going to crash, we're all going to crash. Being diversified is not going to bail you out. That said, I think I heard...
Well, could it minimize it, though, Aswath? I mean, I don't think he's saying it's going to bail you out necessarily, but mitigate some of your losses, if we get that.
Not really, not if you're in equities. The only way you can mitigate your losses is by getting almost entirely out of financial assets. And I think that's the reality we face since 2008, is unlike the old days where you had geographic correlations that could help you, or maybe one class of equities did well when another did not, I think we're all correlated to the point that if you had a major crash, it doesn't matter what your portfolio is going to looks like. If it is 100% equity, you're going to feel it. So the only way out of this is to take your money out of stocks and put it into cash. And the problem with that is if you're wrong, I mean, there are people who have been in cash since 2013 telling us exactly the thing that Professor Shiller said last week. And the cost of staying out of the market often is greater than whatever you might benefit by staying out of the next crash.
Yeah, and do you see a crash coming, by the way? We're just talking like, hey, if there's a crash, I mean, is there a possibility of that?
There's always a correction coming. It's only a matter of time. When you've been doing well for a decade, there's always going to be a correction coming. The real question you have to ask yourself is it worth it to actually reallocate your portfolio to try to avoid that correction when you don't know when it will come and how it will come and what form it will take? I have never been able to make that prediction solidly enough to start to reallocate my portfolio. Maybe there are others who are better at timing the market than I am, so I'm not going to stop other people from making their own judgments. But for me, market timing has never worked.
Aswath Damodaran of the NYU Stern School of Business. Aswath, a real pleasure to get your views of the markets and Tesla. Thank you very much. We'll chat with you again.
Thank you. Take care.
Take care, folks. And thank you for watching Trading Nation. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.